Hello everybody. Today we are going to talk about risk to reward ratio in Forex trading. If you have been following the previous videos, I've been living in a hotel for the past couple of months kind of thing. So you might be hearing voices, sounds, because I'm recording and I have been recording in the hotel lobby for all that time. So I hope that doesn't bother you. But let's get into our topic of today, which is risk to reward ratio in Forex trading. This is part of the whole series of Forex risk management and how to manage your capital and save it from ruin by following certain risk management rules. Today the topic is, or the number of risk to reward ratio that we are going to discuss. In my point of view, it's part of a triad. It's part of three very important numbers. The first number we talked about in the previous video, which is how much exposure you are willing to take with every trade, which is the risk per trade that you're willing to take. The second number is the one that we're going to talk about, which is the risk to reward ratio, or what is famously known for as the RRR. The third number is the lot sizing. What's the lot size that you're going to choose? And this is going to be the topic of the next video. Now let's get into it. The RRR risk to reward ratio, in very simple terms, is if you decide to risk, for example, 1% of a $1,000 capital, that means you are going to risk $10 out of that capital. So for the RRR comes to ask the question, for the amount of $10 or 1% that you are going to risk, how much do you want to gain? How much do you want to profit? Do you want to profit $10, which is a 1-to-1 ratio, risk to reward ratio, or do you want $20, which is a 1-to-2 risk to reward ratio? Now, this is my diary, so what I'm going to tell you is what I follow. And there isn't a right or wrong method. It's just what's good for you and what your style is, what you prefer. I choose a 1-to-2. Let me show you something here. This is where I log in my RRR. What I choose is at least 1-to-2, but I have my exceptions. But look at this 1-to-2, how it saved me, because I did in the past couple of weeks, I did a mistake. I have been saying that for the last 2 years, I have been only on a demo account. I have not touched my live account. So, and this is the one, the demo account, the one that now I am using to test the trading methodology that I have chosen, and I've shown it in a previous video, and I should treat it as my live account. The mistake that I have done, since I'm treating this demo account as a live account, I shouldn't have used it to test new strategies and new methodologies. I should have opened another demo account to make such tests. But anyway, the mistake happens, and this is the name that I chose for the new strategy. And look, the red color, that means how many times, the red color means this trade has lost, and the green one, that means the trade won. Look at the number of times that I used this from this one, from 79. All of those are losses. This is still open, it's in the green now, but it's not moving much. But for our topic today, look at the effect. Because I'm using at least a 1 to 2 ratio. That means if I'm risking $10, I want to gain $20. Because of the previous trades, all those losses, and my capital is still in the green. And this is, in my point of view, the power of risk to reward ratio that you choose that can save your account from ruin. I'm not sure if we're going to get into the exception that I use. Let me see. Let me try to show you something. Let's hope that could be beneficial and clear. Okay, let's look at this euro dollar chart. It's the daily chart. We can see here this one is an order block, and this one is resistance, and this is an ABC. So there are different points where a price could reflect from, and this is the Fibonacci 0382 level. And I am not sure, because there is no real cluster, but look at this resistance. Although this resistance is not very strong, it coincides with this ABC, but the price is very far away. Those little dots here are pivot zones, daily pivot zones, okay, and I plot them on all my charts to see where the price on every time frame, how it reflects on every time frame. So the question to myself, there is a trend line and an order block and resistance. Should I sell from here? Should I sell from here? Should I sell from this level, or should I sell from this level? In some cases, I might use multiple positions or multiple trades in such cases. For example, I might use this trend line and the order block and choose to trigger a trade, a short trade from here. But let's say the price goes up, so I would put the trade here and the stop loss is here. Normally the profit in this case would be at this level, the take profit, because this is support, okay, and the price might come here and reflect just like it did at this point and at this point, okay. So if the position that I took is here, that means, and the stop loss is here, that's way lower than even 1 to 1. I don't know if it is half, okay. And then I choose another one at the Fibonacci level with the same stop loss and the same take profit, and I take another point, another short position, for example at this level, with the same stop loss and the same take profit. In this way, if the first trade is less than my target RRR, which is 1 to 2, the other 1 or 2 depending on the case, would average this trade. This is the only exception where I might accept a trade which is less than 1 to 2. To calculate the 1 to 2 is very easy. You have one of two ways. The first way is the manual way, where we choose a calculator and then calculate the stop loss distance from the entry point, and say that, well, the stop loss is 20 points, 20 pips, okay, away from the entry point. If this is my stop loss 20 and the minimum that I accept is 1 to 2, that means I multiply this by 2, and then my take profit distance is 40 points from entry point. This is one way. The other way is I go to my trading view and I'm going to choose a short position here, and let's say this is the first trade that I want to take, and this is the take profit area, and this is my stop loss area. Okay, that means it's 103. This is my first position. Let's say my second position, what would it be? My second position, we said it's at the Fibonacci level. See, it went up to 2.78. And the third suggested one is approximately at this level, okay, which is about 6.06. So that means for the 10%, or for the example that we have put, a $10 risk in this particular trade, it would give me $60 if it went to its take profit. Okay? But this is dangerous on another rule, which is how much exposure would you have in your total open trades, which is another topic that we talked about when we talked about exposure. In my rule, I only open 3 trades at a time. Now, these are pending orders, so they might open or they might not open. In my calculation, if it triggered the first one, I can still take another 2. If it opened the other ones, then I would stop trading and I will wait and see what will happen. I hope this video was clear, helpful, and can give you an idea on the impact of deciding within your risk management plan how you can protect your capital. And until we talk in the next video about the lot sizing, which it has a lot to do with the stop loss distance. It will complete the circle of risk management. So starting with first setting your financial goals, knowing your psychology from greed to fear, then deciding on your exposure per trade and total exposure in all the open trades. And in today's R&R video, the next video is going to complete the risk management plan, where we will talk about lot sizing. Thank you very much and see you in the next video.